So to recap, what we covered on uh, Monday was this. Let's pick a better color here. We covered purchase transactions where we're buying inventory. Okay, so now we're going to talk about this next part of the kind of the cycle here, the business cycle, is to talk about when you sell inventory. And you're going to see similar concepts, freight cost, sales discount, but now you are the one offering. Okay, so I think I started this, but let's just make sure that we, again, go over what we covered at the end of Monday, because I think we did start talking about this. So again, the key thing to remember is that when you're selling inventory, there are two journal entries. Okay, again, our business model of a merchandising business is to buy low and sell high. And so when we sell inventory, that's the time where we're going to capture this, because this is all income statement stuff. Buying low is kind of the expense of buying the item, and then selling high is the revenue. So we want the revenue and the expense of that inventory to be on the same income statement. Okay, you guys walking in late? It's like, yeah, you can like say hi to your friends and stuff, but like you came in late. So next time, like kind of do that before class. Don't disrupt if you can avoid it. Okay, so there's two journal entries. So you see we have one sales transaction. It's dated the same, but there's two parts of it. There's one part that is capturing the revenue, and then one part that's capturing the expense. Okay, so again, the revenue is how much you've sold it to your customer for, and they're going to either pay you cash right then and there, or you're going to have an account receivable. So it's going to be either one of those two options. And then on the expense side, we talked about this. Cost of goods sold is an expense account, right? I think we repeated that. So again, just to remind you, and just like all expense accounts, it's a debit. And we're reducing our inventory by that same amount, by that amount of whatever we paid for that inventory item. Okay, so we're converting an asset inventory into an expense in this part of in this second journal entry. Okay, so you can see that we made a profit. Really, we're gonna have these two be showing up on our income statement. Revenue 5,000, expense 4,200. So how much profit did we make? Gross profit $800. Thank you. This is not, it's called gross profit because this is not the end of it, right? Because we still have our utilities, our employees, we have all the other expenses that our business has to incur to have our shop and whatever. But just on the basic buy low, sell high, we've made $800. Okay, on this single sale. Okay, and then we see how this kind of flows to the T accounts. Uh, we see that our inventory is dropped. We now have less inventory because we've sold some of it. Okay, and then all the other, we have this expense here. And again, these two will appear on your income statement together in the same period. We might have bought this inventory a year ago, right? And until then, it was just hanging out on the balance sheet as an asset. But now when we sold it, we've matched it to the revenue because we want the cost of the inventory and the revenue to be on the same financial statement period. Okay, everyone clear on this? Any questions? No? Okay. So just like when you were purchasing inventory, your vendor offered you sales discount, you can also offer your customer this. So it's the same notation, okay? Exact same, 210 net 30 or net 45 or whatever that same those same notations that we talked about, you're now offering it, right? Instead of receiving it. Okay? But the notation is the same. So again, you will assume that your customer will not take the discount. So you're going to record the revenue at the full amount. okay, at the time of the sale. If they do, we could potentially, so the way that you're properly supposed to do it, you have this contra revenue account called sales discount, and it's a debit because revenue is, we see here, credit normal. Since sales discount is a contra revenue account, it's debit normal. It's the opposite of what its buddy account is because it's a contra account. So you can see there's a debit here. We could have, hypothetically just done this. You could have just debited sales revenue when someone took the discount. Because remember, when we originally recorded it, we said we're having revenue of 5,000. But if they take the discount, then we're not actually going to receive 5,000. We're going to receive 4,900. So we could have just done this, and this would have went to 4,900. But we basically want to track the discounts and the returns we're going to see. We're going to track them in separate accounts. Why? Is there some information in that? What if you have a lot of sales revenue, but then you have a lot of returns? What could that mean? Yeah, your product sucks, right? It breaks a lot. It's like of poor quality. Okay, so there's some information in keeping these accounts separate. Okay, a financial management, your financial statement readers, they may want to know these different things that happen, right? Because again, like sales returns, there's some information and how much that was as a portion of your revenue. Okay, so if you just tracked everything in sales revenue, you're going to kind of net all that stuff together and you're going to lose that. So we're going to track it separately in separate contra accounts. So we have sales discounts. We're going to have another contra revenue account called sales returns and allowances. So we're going to track all that in different accounts. So you see in this transaction, I guess, let's get rid of this. So we have the account receivable. This is at 5,000 because that's how much we recorded this originally. We wanted to go to 0. So we achieved that. The customer knows that they're getting a discount, so they're not going to give us 5,000, just going to give us the amount less the discount in cash. And then this sales discount is going to be kind of the place filler. It's going to be a debit, and it's a buddy account to sales revenue. So you can see here the net revenue is 4,900. We have a credit balance here and a debit balance here. The net of that is a credit balance of 4,900, which is how much our net revenue is. Okay, makes sense? Okay, good. Okay, so again, we have the same thing with sales returns and allowances. There is a difference now, right? When we're talking about purchase transactions, a return. Does anyone remember what the difference between a return and an allowance is? Who remembers what the difference was? What's your name? Yeah, you. Yeah. Ruben, what do you think? Do you remember what the difference is? Returns versus allowances? No? Yeah. Aiden. Yeah. But you still give them like you won't owe the money for it, but you just keep the physical item, right? Yeah. So with purchase transactions, there is no difference in the journal entry between those two scenarios. When you are the seller, there is a difference because in allowance, you're not getting that inventory item back. Okay. Versus a return, you are getting it back. So if you're giving an allowance, you're basically not going to have this second journal entry. Okay, so you can see here when we have a return, so this is a return, okay, we're getting that inventory item back in inventory. You can see this asset is going up. We don't have a contra expense account for cost of goods sold. We just directly credit this, right? Because again, cost of goods sold is an expense account. Its normal balance is debit. But in this case, when we have a return, we're gonna debit inventory to account for that item coming back. And we're going to credit cost of goods sold because we no longer have that expense, right? We're kind of undoing part of the sale. Okay. And then kind of here too, it's the same. We do have a contra account for returns, as I mentioned. So we're not just debiting sales revenue, but we are also reducing this account receivable for the balance because this person is no longer owes us for this item that they're returning, right? So we're going to reduce their account receivable. So you can see it in the T account here. We started off with 2,000. That was the original sale. They returned half of it. So they now only owe us for that other half that they've kept. Okay. So accounts receivable, check. That's fine. Sales revenue, we originally recorded 2,000. And again, half of that is not revenue anymore. So really we need some debit here of 1,000. But instead of putting it directly into this account, we don't do that. We have this contra account that has the debit. Okay, so again, these two net together. So our net revenue is 1,000. So that's correct, right? When we take the account with its contra account together, that gives us the correct number. Inventory, we're adding back that 750 because this is a return, right? The allowance is not going to have this part, but since this is a return, we're saying it's a return of half the order. We're going to add it back in. And the cost of goods sold, this was the original. So our original profit or kind of transaction was 2,000 revenue, 1,500 cost of goods sold. Half of this cost of goods sold is coming back. So now we're kind of, we have now the correct $1,000 of revenue and the 750 of cost of goods sold. Okay, everyone good with this? So the key thing to remember is when you're purchasing inventory, returns and allowances are the same. When you're selling, it's going to be different depending on whether it's a return or an allowance. Okay, so if this was instead of customer returned half, it was you gave the customer an allowance for half, you would just not have this part because you would not have gotten that item back. Okay, so you still had that cost of goods sold. You're not going to undo that expense because you paid for that item and you're just kind of giving it away for free. So that's still going to be an expense for you. Okay, you are only going to have this transaction for an allowance. Yeah? Does that make sense? Yes, I see people nodding. Okay, good. Okay, freight expense. Okay, so again, this is another difference between whether you're purchasing or you're selling. Okay, so what did we do with freight costs when we were paying for inventory to be delivered to us? What did we do with that freight expense? Does anyone remember? Yeah, Mohammed. Exactly. This terminology it was capitalized. Okay, it's some outflow, but we're treating it as an asset, right? It's going to go into inventory, which is an asset first, and then it would be expensed when it's sold. So cost of goods sold, you can technically say this is not just how much we paid for the item, but it's like including all the freight and everything, right? We're gonna expense it at that time, and it's gonna be some methodology because let's say you paid $50 per unit to buy it, and there is a freight charge of whatever $100. If you bought 1,000 units for that, you could divide up the total freight by 1,000, and that's like your all-in unit cost. You'd have to figure out a methodology to split the expense of the freight when you're purchasing it to say how much each item cost you all in, right? So there'd be some methodology, but I guess in general, what I'm trying to say is that cost of goods sold is kind of the total cost of your inventory, including freight. That's how much you would expense when you sold it. Okay. But when you're selling the item and you're paying for freight to deliver it to your customer, you're going to expense it right away. It's it's like a service you're providing to your customer. Okay, so that's an expense because the revenue for that sale you're recording at that time It's like you're also providing this extra service to them. And so you're going to also expense that at the same time of the sale. Okay. Does everyone understand the timing difference here? When you're buying inventory and paying for freight, it's the associated revenue has not yet happened, so you're going to keep it as an asset. When you're selling the thing and paying for freight, the revenues happen, right? This expense is part of the sale, you can say. It's like paying a commission, you can say, if you had a salesperson. So this is like an immediate expense that you're going to take because it's part of the revenue. Okay, so we're going to record it as a selling expense. Okay, so this is separate than cost of goods sold. It's not related to how much you paid for that inventory. It's like this extra service you're providing for your customer. That's what you're expensing. Okay. Okay. So I think now we're just going to practice a bunch of these transactions. Okay. Just do a bunch of journal entries. You're going to have a bunch of different customers. Some are offered credit terms, some are not. Some are going to pay within the credit, like within the discount period. Some are not. So you're going to have to now have a little exposure as to like how this looks. Okay, so we're going to do 5-40A. It's in the sheet, so you can open that up and we can start working on that. Okay, so the first one, purchased merchandise inventory. So the first question is quite obvious. This is a purchase transaction. Okay, we're buying inventory. So inventory is going to be one of our accounts, and we're buying them on account. So we know that, is it accounts receivable or payable? Payable, right? This is money that we owe our vendor, and it's $8,000. Okay, so the first journal entry, inventory debit, we're getting this asset, and it's going to be $8,000. Okay, and this was, I think, what was it, November 4th. Okay, first one, done. Second, we paid freight bill of $160 on November 4th for this purchase transaction. So again, in purchase transactions, when we pay for freight, we're going to capitalize that, right? We're going to store it as an asset because we want to match that cost of inventory with the revenue whenever we sell that item. Okay, so let's say, I'm just going to add a little flavor here. Let's say this was for, we had bought 50 items, okay, 50 units of some item. Not only, and let's say it was $8,000. So our total unit, and of course your company would have to have some methodology to do this. And I'm assuming we're just buying one item, which is maybe not necessarily the case, but it'd be $8,000 divided by 50 units. So that's how much it is per unit. And then this $160 for freight divided by 50, that's the freight per unit, right? So really, when we did cost of goods sold, when we sold this, let's say we sold 10 items at some point, our cost of goods sold would be this times 10, which includes not only the cost of the item plus the kind of per unit shipping cost, right? So this 1,632 would be my cost of goods sold if I sold 10 of them. Okay, does that make sense? How that freight cost would eventually be expensed? Yeah, because again, this is my cost of goods sold for 10 units. Yeah. Okay, so until then, though, it's going to be stored in inventory, just like this 8,000. So it's going to be inventory, and it said paid for, so we're going to assume it's cash. Okay, makes sense? Yes, everyone good with this? Okay. We returned half the inventory purchase. Okay, so um, this shipping cost is like kind of a sunk cost. We're not going to like undo half of that. Okay, because it doesn't say we're paying for shipping, return shipping or anything. We're just gonna basically not owe $8,000 anymore. Okay, so AP Right now, it's a credit balance. I want it to be 4,000 because I'm only going to pay for half the items because I'm returning half of it. That means we're going to have to debit accounts payable 4,000. So I have half my journal entry here. So then what am I going to do? What's the other half? So AP is debited. What should I credit? Yes, merchandise inventory. Exactly. And again, even if it was an allowance, in this case, it says it's a return, so we're actually giving the items back. If it was an allowance, we would still do this same entry. Why? Because the inventory account is not a physical count of inventory. It's the value of the inventory. It's how much we've paid for it. Okay? So if we were given an allowance, even though the physical item was still there, the value of it from an accounting perspective is zero because we're not going to pay for it, right? The vendor is going to subtract that off from how much we owe them. Okay, so I think this is a key concept to remember, that the inventory account and the physical unit count are not the same thing. The inventory account is just keeping track of our cost of the inventory, how much we've paid for it. Okay, so it could be that we have stuff in inventory that we didn't pay for because it was given to us as an allowance. Okay, everyone clear on that? Make sense? Okay. Okay, so let's just do this next one and then we'll keep working. Sold merchandise inventory for cash, 1,700. Cost of goods sold, 680. Now look, I'm giving you a little preview of next chapter. They're just telling us this cost of goods sold, okay? All of chapter 6 is how did this cost of goods sold come about? It's going to be, we're going to have to we're going to have to know the units, the number of units, the unit cost, but that's all going to be in the next chapter, okay? So for now though, we're just told what the cost of goods sold is, okay? So it's a little easier. Next chapter, we're going to double click into cost of goods sold and understand that better. But for now, it's a little simpler because they're just telling us. Okay, so again, for every sales transaction, how many journal entries are there? 3? Okay, 2. Exactly. Okay, 1 for the revenue, 1 for the cost of goods sold. Okay, so it's telling us our revenue. The revenue part of it is 1,700. This is how much our customer is paying us. So we're going to have some sales revenue. And in this case, they're paying us cash. That's what it said right here. Inventory for cash. Cost of goods sold is 680. So this is the first journal entry. The second one, we do cost of goods sold. That's our expense. And our inventory asset is reduced by that same amount. Okay? All right, any questions on this so far? No? Okay, all right, keep working then. Okay, so we left off at, I think, November 11th. Okay, so this is another sales transaction. Okay, so sold merchandise inventory to this corporation on account. Okay, here's our revenue, 10,300, and our cost of goods sold is 5,150. It's giving us all these credit terms because we sold it on account. Okay, so again, for cash transactions, it's irrelevant to have credit terms because you've already received the cash, right? So the credit terms are only for when you're buying or selling on account, because you're trying to incentivize, either your vendor is trying to incentivize you to pay sooner, or you are trying to incentivize your customer to pay you sooner. Okay, so in this case, we're trying to get our customer to pay us sooner. Within 10 days, we're going to offer them a 3% discount if they pay us within 10 days. Okay, so, but we don't know what's going to happen, right, when we record this transaction. So we're just going to go one step at a time. Again, we're assuming that they're not going to take the discount, and we're going to record the full amount of the revenue. Okay, so we're going to record 10,300 in revenue. And again, it's called sales revenue, not service revenue, sales revenue. And it's for accounts receivable. And you can label it by the customer, okay, just so we know whose account receivable is whose. Okay, because when they start paying you off, you're going to want to know what their outstanding receivable is, because some of them are going to do returns, etc. So you want to keep track of how much they're owing you when they pay you off. Okay, so that's the first part of it, because again, every sales transaction has two parts. So that's to record the revenue. The second is to record the expense. This is again sell high. This second one is buy low. How much should we buy this inventory for? We're selling this inventory. Yeah. Okay, so look right here. See this up here? You just have to resize the column. It's just not big enough to view it. Okay, so cost of goods sold, debit, because it's an expense. We have to reduce our inventory asset by the value of this inventory, because it's no longer an asset for us. It's gone. We've given it to our customer. So we have to reduce this inventory asset by that value. So again, cost of goods sold is converting an asset into an expense, because it's, you can think about it in a couple ways. You had to pay for that inventory that you bought. You had to pay for that inventory that you sold, so you're recording how much you paid for it. Or you can think about it as like you no longer have inventory, right? It's gone. So you have to reduce that asset. Okay, and the value of it was 5,150. So it's a pretty, you're making a big margin on this. You bought the items for 5,150 and you sold them for 10,300. So it's like 100% profit margin, or 50%, right? Yeah, 50%. That's you're doubling your money in the sense that you bought it for 5,150, you're selling it for 10,300. But the way you'd calculate the margin is it's the cost of goods sold divided by the revenue. So it's a 50% gross margin. Okay. Okay, so that's just one transaction. This is one sale. Okay, so this is both of these are related to this transaction. Because again, each sales transaction has two journal entries. Okay, we paid freight for the November 10th sale. So again, I asked myself the first question, is it a purchase or sales transaction? So this one is related to a sales transaction. And when we pay freight for when we're the seller, we expense it right away, because again, that's like a service I provided for my customer. That's an expense for me in that period that I generated the sale. Okay, so this is going to be November 12th. You can call it freight expense. This is like a selling expense. This is like an expense that is part of your, it's like a cost of doing business to generate the sale. Just like if you had a salesperson, you pay them a commission. It's like a similar thing. Okay, so and I think it said we're paying with cash. Yeah, $30. 30. Okay, everyone good with that? Yeah, you're gonna have another one where you're paying freight for a purchase transaction. So again, that's gonna be treated differently than this. Okay, so let's just do one more. Sold merchandise inventory to this different customer for 9,000 on account. We offer them some credit terms, and then our cost of goods sold was 4,500. So again, we're going to assume that they're not taking the discount. So we're going to record the full amount of. So I can basically just copy and paste these. It's the same accounts, except I'll just change this to, instead of Gunnison, it's California Corporation. Okay, and I think it was 9,000. And then my cost of goods sold was 4,500. Okay, so it's the form is the exact same. So, and it's going to be for every sales transaction. It's just going to be different customer. And you can see we offer them different credit terms, right? So you'll have to go look back once they pay us off and see what the credit terms were, what the discount was. But for now, we're not worrying about that yet because we don't know ahead of time when they're going to pay us. Okay. Let's just do this the 14th, and then I'll let you guys keep working. So paid the amount owed on account from November 4th, and they're giving you a hint here because there is a return and there's some discount. So let's see. So November 4th, we were offered 110 net end of month credit terms. So we had it until what day to pay this? Okay, so look, this date of this transaction is exactly on the last day to get the discount. So we're going to get the discount of 1%. Okay, we also had a return here. Okay, so they gave you a big hint about doing this journal entry because they're telling you the net of the discount and the return. So that you should already be cluing into being like, okay, well, what were the credit terms? And let me see how much I returned, just so you kind of, it's a big hint because you would have to be tracking these in T accounts to like have seen otherwise. Okay, so initially we had an account payable for 8,000. So let's just be explicitly clear what's happening here. So we started off at 8,000. From this return, if you look back, we had a debit to accounts payable of 4,000 because we returned half of it, this 4,000. So right now, our total outstanding balance is 4,000. Everyone good with that? And of this, how much cash are we going to pay them? 4,000? We know that this is going to go to zero because we're going to pay them off. Okay? But are we going to pay them the full 4,000? No. We're going to pay them 99% of it. But I know that I need to debit accounts payable 4,000, right? Because I need this accounts payable to go to zero. So I'll just start with that, 4,000 debit to accounts payable. I know I'm going to be paying some cash, but it's not if I wasn't getting the discount, it'd be easy. It would just be this. But since I'm getting a discount, I know the actual amount of cash I'm paying is less than that, right? So the amount I'm paying is this times 99% because I'm getting a 1% discount. Okay, so I save 40 bucks. But this is not a valid journal entry. Right? Do we agree? Okay, so I need to have a $40 credit to something. So what should I credit? Inventory. Yes, that's right. And explain to us why inventory. So I agree with you. You're right. Okay. So look, this is as it stands, my balance of inventory is 4,000. So before this journal entry, it's saying that the inventory I have is my cost is 4,000. Now, is that my actual cost? How much did I actually pay for this inventory? Yeah, 3,960. So it should be this, right? 3,960 or 40? Is it? Yeah, no. Okay, so then how do I get from 4,000 debit balance to 3,960 debit balance? What do I need to do? I'm not using subtracting. What is it? You're right. You're right. But we don't use addition and subtraction. Exactly. Thank you. You need to credit inventory by $40, right? And so once I have this credit to inventory for 40, I will have the correct amount I paid for this inventory. So that's where this credit to inventory fits into it. So now my inventory balance correctly reflects my actual cost of that inventory. Make sense? Okay, good. Okay, all right, so keep working. Okay, so I think we left off um, on this, so November 16th. After negotiations, we granted Gunnison $200 allowance. So if we look back up here, AR for Gunnison, and I kind of want to start a T account for these account receivables because we're now having returns and allowances and stuff. So we initially had 10,300. I'm giving them an allowance, so they're only going to owe me 10,100. So in order to do that, I need to credit their account receivable. This is Gunnison by 200. So I know I'll have a credit to AR Gunnison 200. And I kind of have to undo some revenue, right? Because that's like less than I could say that I've generated in sales. And again, we could do this and that would be coherent, but we have these contra accounts that we're going to use to track when our customer takes discount or when we have a return or allowance. So instead, we're going to move this to our sales, returns, and allowances account. Yeah, Margarita. Yeah, sorry. Yeah. So what was this, November 16th? Yeah. Okay. And I only have to do this one journal entry because it's an allowance where I'm not getting those inventory items back. So I don't have to do anything with inventory or cost of goods sold. Okay. That's the difference in a sales transaction between returns and allowances. With allowances, since you're not getting the physical item back, it's a loss. I already expensed it because it's like kind of left inventory and it's not coming back in this transaction because it was just an allowance. So that cost of goods sold that I originally recorded is correct. Okay, I don't need to adjust it at all. Okay. So on the 17th, I received defective inventory from the 13th sale. So this is from California company. Originally 9,000. So again, I'm going to start another account receivable for California company. It was 9,000, and it's saying that I'm giving. They're going to return $400 worth of items. Okay, so that's how much. Like on the revenue side, it's worth 400, right? That's how much the related value in revenue was. So I'm gonna have to reduce the amount they owe us by 400. Okay, and then so it's gonna be the same kind of transaction as we had here, at least this first half. It's gonna be AR California instead. Okay, so 400, 400. But since this is a return and not an allowance, I'll have a second thing I have to do, which is to put that inventory back. Okay, I'm putting it back into inventory. I'm getting that item back, and I'm going to reduce cost of goods sold by the value of the inventory, 200. Okay, everyone good with that? Again, there's no contra account for cost of goods sold. We're just going to directly do a weird thing and credit a expense account. Okay, so this this system is it's not always super consistent. Okay, you could ideally say, hey, why don't you have a contra account for cost of goods sold that is credit normal, but just the way that we set up our books and the way we're learning, we're just going to directly credit cost of goods sold. Okay, but if you were the controller of the company and you wanted to track these returns separately, you could set up a contra account to cost of goods sold. That it would still get you to the same like end product, but you just have one extra account to track in your accounting system. Okay. Okay. So November 18th, another purchase transaction. So again, I'm just gonna kind of copy and paste. We can just use these four, except it's to Rainbow Corporation, I think that's what it was called. It's gonna be the same stuff. $3,700 of revenue, and oh wait, this is a purchase transaction. Sorry, so totally wrong. It's gonna be this. So I'm gonna get rid of this. 3,700, 3,700. Okay. And this is AP. I guess you can track the AP separately. This is to Rainbow. That's our vendor, not our customer, because this is a purchase transaction. Okay. All right. So now there's a bunch of payoffs. So I just want to make sure that you have a chance to try this on your own. As you can see here, like Gunnison, this is my account receivable. So when you calculate the discount, it's going to be on this 10,100, not on this 10,300. Same thing with California. It's on this discount is going to be on this 8,600. Right? So just take a couple of minutes to finish up. I think some of you are still working on those last couple of transactions, and then we'll make sure we do them correctly together. Okay, so where were we? This 20th. Okay, so received cash from Gunnison Corporation, less allowance and discount. So I have the accounts receivable balance for Gunnison here. And this is net of the allowance, right? We had a $200 allowance. So this is how much they owe us on a gross basis before the discount. Okay, so will they get the discount? Let's see. Okay, we offer them terms of 310 net end of month. So they had till the 21st to pay us. And we can see here that they are paying us on the 20th. So yes, they will get this 3% discount. Okay, so 3% means that they're going to pay us 97%. But 97% of what? It's going to be 97% of this outstanding balance. So I can just do a quick calculation here. We're going to receive $9,797 in cash from Gunnison. That's the check that they're going to write us, because it's going to be for the amount they owe less the discount. Okay, so I'm just going to debit 9797 right now. I at least have figured out this very common sense thing. 9797 debit to cash. The other easy thing I know that has to happen is that I need a credit of 10,100 to AR Gunnison, because they will no longer owe us any money after this. So I know that this account has to go to zero. So I'm going to put a credit here, 10,100 to accounts receivable Gunnison. Okay, but every journal entry, number 5 here, do our debits equal our credits? No, it doesn't. Okay, so I need to fill this in with $303. Now, I could do sales revenue, and that would be coherent, because really, when I first recorded this account receivable, I like kind of puffed myself up. I'm like, I'm going to receive X amount of revenue, but I'm actually receiving less than that because they got this discount. Okay, so I got to reduce my revenue. But again, we have actually a separate contra account for discounts when our customers take it. It's called sales discounts. Okay, so we're kind of completing it here. Yeah.
Treating it as expense, right?
Sales discount is a contra revenue account. So it will just reduce the amount of revenue that we show.
When we calculate net,
Yeah.
not in the other statements.
Yeah, I mean, I think I think we saw on the way that a company does it, they just report the net revenue. They don't show here's the gross revenue, less the sales discount, less the you'd have probably maybe it's in the notes to the financial statement, but they're just kind of reporting what the net revenue is.
They already
Yeah, exactly. They already subtracted it. Yeah. Okay. Okay, we paid off the amount owed on this one. We're getting a 2% discount because we had it till the 28th. And again, this is the discount that we're taking as the purchaser of inventory. Okay, so this is going to be different where we're going to deal with our inventory balance, right? So I just want to figure out how much cash I'm paying. So I do 3,700 times 98.98. So this is 3626 is how much cash I'm going to pay. So I know, again, this is how I start these calculations. I just figure out what is the cash being transacted, and I know that there's a discount. So this is the amount I'm paying to my vendor, 3626. So I'm just going to put that first as a credit, 3626 cash. I also know that my accounts payable has to go to 0. So I initially recorded it, I think it was here, 3,700 credit. So I know I need to do a 3,700 debit. And of course, there's a difference here that I need to bridge. And this is going to go to reduce the value of my inventory. Because my inventory balance was debit 3,700. I'm going to credit it to get it in line with how much cash I actually paid. Okay, everyone good with that? You already saw that, so hopefully this is a repeat. Okay, so the next one is received cash from California company, less return and discount. So again, we have this is our balance net of the return. California company had 115 net 45, so they had till the 28th to pay. They're paying on the exact last day to get the discount. So they're going to pay us in cash 99% of this. So I'm going to multiply it by 99. So it's 8,514 is the cash we're receiving. So this is okay, good. Okay, so what I did is shift spacebar highlights the entire row. Okay, now I do Alt I E is to insert row. So again, this is like takes practice. If you use Excel a lot, you'll learn these quick keys and it'll become second nature. So again, spacebar and shift. I hold shift down, press spacebar. I can insert a bunch of rows by just holding shift. My finger's still on shift. I just press the down key, and then I can insert like 5 rows like this. So now I let go of shift, do Alt I E. Okay, that inserts all these rows. Okay, so this is the cash coming in. My accounts receivable for California needs to go to 0, which I think was 8,600. Okay, so I need to bridge this gap of $86, and that's going to go to sales discount. Okay. All right. Any questions on that? I think this is a repeat of what we already saw. Okay. And then the last one, purchase inventory. and we paid freight. So it's actually two separate transactions. You could combine it into one because it's all going to be debit to inventory, credit, cash. Um, so you could do it like this. You could do it as two separate transactions. Or you could have, sorry, 12,000. Or you could have just made this 12,200. Now, you have some discretion as the accountant how you want to do this, because all that matters in the end is that your ending balances are correct. Okay, so both of those two are going to give you the exact same balance for inventory and cash, but you would just have to write a memo so that the manager or whoever understood what this what was the economic reality of that journal entry, like what was going on, because it's not clear by just looking at it what was happening. So you would have to, as a thorough accountant, kind of make a memo to say that, hey, this was for the purchase and the freight. The freight was 200. So you would have to figure out a way to convey that information in your accounting books. Yeah.
The book cares which way you do it, what the book wants.
It probably has two separate ones. Yeah. Yeah, but it usually tells you like first record the whatever, then record. So you gotta the book, unfortunately, you gotta just be very meticulous about reading the instructions because it's like not obvious all the time. Yeah. Okay, everyone good with this? This is like the hard part of the homework, just doing these journal entries and tracking the balances and making sure you're calculating the discounts on the net of returns, all that kind of stuff. That's the tricky part of this chapter. Okay. All right, so let's finish off here. Okay, so here's like a street smart question. I gave you a little hint, okay? If you had 5 widgets in inventory, you bought 10 more and sold 8, how many should you have on the shelf? And if you went to the shelf and counted and it was different, why could that be? So take a minute, think about it. You can talk to your neighbor, ask them what they think. Okay, so does everyone agree with this math? Beginning inventory 5 plus 10 is 15, minus 8, 7, right? We should have 7. So in the real world, when you go out there and you go count, what do you think? Am I always going to find 7 there? Why wouldn't you? Give me some reasons why you wouldn't find 7. Okay, yeah, someone could have just bought it, or yeah, you could have made a mistake. Yeah, people be stealing, like people be stealing. Yeah, like that's a big one. Okay, theft. Like as we saw, like with Target, it's a low margin business. Okay, so theft really affects these businesses, right? If they even had like 5% of the inventory stolen, which is I guess a lot, that's gonna like kill all their profit. It's quite a huge expense for these businesses. So yeah, stealing. If it's something that goes bad, right? If it's food, if this widget is a food, it spoils, right? So things can go badly with inventory. It can go bad. It can get lost. You can have a miscounting, and it gets stolen. Okay, so we need some way of accounting for that because right now, if we don't do anything, our inventory asset is going to show 7 units. And if there are only physically 5, then we're puffing up our books, right? We're going to be misstating our assets. We're going to be saying it's worth 100, but it's only really worth 70. Okay, so we need to do something about that. So we have this word or this term shrinkage. Is anyone a Seinfeld fan? No, Seinfeld. You guys are missing out on one of the greatest TV shows ever made. But shrinkage is a term that has to do with all this stuff that happens to inventory: theft, spoilage, damage, errors. Okay, so all these things are going to get tossed into this blanket category of shrinkage, which is basically the loss of inventory for reasons other than selling it. Okay, so the way that we find this out is through physically counting inventory. There's no other way. If we're relying on our accounting books, we would never find this stuff, because this is like physical, actual reality things that happen in the real world that our accounting books aren't accounting for. So we need to physically link up our accounting books with the physical reality by doing a physical count. Okay, so the form of the adjusting entry, so you can see here, this is happening at the end of the period. Okay, so your business will go in and periodically count the inventory and see if it lines up with your accounting books, and it's often not going to. And the difference is going to be reflected in an adjusting entry at the end of the period. Okay, so you can see here that we're taking an expense, cost of goods sold, and we're reducing our inventory. That's basically accounting for this loss that we're taking from all these things here. This. It has to be, it's an expense for our business, right? When all this stuff happens. So you can see the form of the adjusting entry takes that form. We're losing inventory and we're taking an expense. So this is reducing our net income, right? This is reducing our profitability. And so the bigger this is, the bigger the hit is going to be to our profit. Okay, everyone good with this? Okay, so here's the transaction. So your unadjusted balance for inventory is this. So this is what your unadjusted inventory balance is in your accounting system. When you actually go in at the end of the period and you physically count the items, you realize that there's only this much value of inventory. That's you saw how many units over there. You have some per unit value, and you saw that the value of your inventory is only this much. So think about, what is the adjusting entry required to account for this? Okay, so take a second, try to write it down, see if you remember. Let me move this down. All right, who wants to help me? I'm going to pick on someone. What about Roger? What do you think? You guys hide in the corners, so I'm going to, I just naturally gravitate to the people that try to hide. So it is what it is. What do you think, Roger? First of all, what are the accounts involved? What do you think? Inventory, okay. And is inventory going up or down based on this? Because right now what we're saying is that it's right now 10,560. Yeah, okay, so good. So this is what it should be after the adjustment. So we know that we're going to debit or credit inventory. Credit, right? So we need something here. Okay, so what is that number? How should we calculate that? Who wants to help Roger? Okay, so what is that? I didn't do it, but who did the calculation? Yeah, 730. Okay, so we know half the journal entry we already got. It's going to be inventory, credit, 730. So then what should we debit? What does it represent? I mean, is it good or bad for my business that this happened? Bad, right? So what are we going to do? What is the account? An expense. And what expense account are we going to use? Inventory expense. We've been using it. We used it a bunch of times just in this last problem. Exactly. Cost of goods sold. Okay. So when you see cost of goods sold on the income statement, yes, it is the buy low, sell high. It's the buy low part of it, but it's also all this other junk. All these other losses are going to be kind of thrown into that cost of goods sold. Okay. Make sense? So this is our adjusting entry as of, dated December 31st. And that will make our inventory balance correct. It'll bring it down to this value, which is what we're going to put on our balance sheet. And our income statement is going to have this extra loss because, it is a loss for our business. Yeah? Everyone good with that? Okay. Okay. I think nothing really to say too much about the end of period closing. The only thing is we're going to deal with sales revenue now, right? So it's a different type of revenue. Before, in chapter 4, we just had service revenue. So we're gonna have to that. We're gonna have that. We're gonna have also sales discount, and these two are gonna be also having to be closed, and they're gonna be closed. Uh, they're debit normal, so you'll have to credit them to close it. Okay, with whatever their values are. And I think in the homework, if you have to do this, you close it when you close the revenue accounts because these are contra revenue accounts. Okay, so just be aware that they are going to be closed with the revenues, but since they have a different normal balance, instead of debiting like you do for sales revenue, you're gonna have to credit those accounts to close them. And then cost of goods sold, that's just an expense account. So when you close your expenses, those are debit balances, so you credit them. So you'll also credit cost of goods sold and delivery expense. So we just had some new accounts that were introduced. The process is the exact same. Okay, everyone good with that? Yeah, I think the only thing on the homeworks is like these are closed with the revenues. I think that's right. Don't try it out. I forgot, to be honest. Okay, I'm assuming that they're going to be closed with the revenues, not with the expenses. When you do it step by step in the homework. Okay.